Welcome to TheoTrade. This is Don Kaufman. March 5th, 2021, doing the TheoTrade weekend update here on a Friday afternoon. Volatility throughout the course of this week was a rockin' in the markets. I'm going to do a quick kind of market recap, some of the price action that we saw, but much more importantly, everybody wants to know if that volatility is going to die down. And I got to tell you, there are some very specific tells within this marketplace that we're going to detail right here, right now. First and foremost, let's do a little bit of a market recap. Highs to lows and back again. I mean, I'm just going to start with looking at this past day of trade. Obviously, here we are on a Friday afternoon. Take a look at some of the price action. I mean, the volatility, you're kind of looking at this and like, all right, the volatility was sparked by, the employment situation. But no, the volatility started well before that. In the overnight session, we traded all the way down to 37.30. We had actually rallied up. The jobs number actually came out. And again, the employment situation, it's good. The marketplace sells off. The marketplace explodes back. As I said, highs to lows. And when we talk about lows, we got really low, which was 37.30, then exploded back to 38.50. Again, looking at this kind of in a hindsight, you're like, whatever. We went up, we went down. This is 120 S&P points. Ironically, the expected move, in fact, if you take a look at the SPX, and on the weekly expected move was about $124. And again, ironically, that is about what we got today in the S&Ps from the absolute low to the high. So again, we packed in a huge amount of movement. The other irony of this marketplace, the SPX actually finished the week ever so slightly higher. We started the week, and again, it's one of the things that we denote by looking here at this expected move. We started the week, roughly speaking, about a 38.11 side of the SPX. We ended the week, 38.41. So net, where are we? Up about 30 handles on the week, and you have to laugh about that because, again, it was wild. It was a wild week, and one of the things, you just can't ask for more two-sided market action as a trader. And we're talking about two-sided market action. You look at something like Monday, a rip and explosion to the upside inside of the S&Ps, 3 days of just wicked sell-side activity. Touchdown again, just ignited off of the bottom inside of today's trading session. So again, volatility is everywhere. Now, let's get to some of really the important aspects, things to kind of focus on kind of moving forward. One of the first things that we want to bring up is going to be bond volatility. Listen, I could sit here and really discuss, everything from like MACDs and Fibonacci's and Bollinger Bands. We could look at charts till we're blue in the face. The only real takeaways, from the S&Ps right now is that we're seeing expansive ranges, obviously a lot of volatility on an intraday basis. In the S&P futures, one of the things that is a bit of a standout, the volume in the S&P futures, all right, it's getting up there. I mean, we're doing clear up to near 3 million contracts. And if you've looked at any prior and significant periods of volatility, and this is important, look at prior and significant periods of volatility, you'll see that we have to get to that neighborhood of about 3 million S&P contracts. And why the S&P futures are so important, that's where order flow goes to mitigate exposure, to mitigate risk. So it's indicative of like hedging activity. Now, if you actually look back here, this is the onset of COVID. This is actually some of the COVID crash. And we were doing clear up on certain days to 4 and 5 million contracts, but neither here nor there because it's a little bit of an outlier, right? In other periods of sell-side activity in the last 3 years, though, you actually will see us get up to between 2.5 and 3 million contracts kind of a day when there's a degree of capitulation. And the interesting irony is when you zoom in, the last couple of days, we're right there. I mean, we're doing some serious size, and that's important. But before we go any further, I'm going to tell you right now, there's nothing looking at an S&P chart that is going to distinguish what this marketplace is going to do. There's nothing looking at a Nasdaq chart. I know everybody wants to point a finger. It's Tesla. It's Tesla. We're going to talk about Tesla in just a few minutes. The first thing you really have to kind of decipher is what is driving some of the volatility, the underlying reasons. Because to look at a chart, I'm telling you, right now, you're going to give yourself a false sense of security. The fact that we did bounce up, the fact that hey, listen, we're just a hop, skip, and a jump off all-time highs. First, we actually cruise over to bond volatility. Now, most people are not intimately comfortable looking at a ZB, or they're not necessarily looking, at the notes, which is, of course, the 10-year. Okay, so for bond volatility, I think the way that I'm going to denote this is I'm actually going to look over here at the TLT. Okay, with the TLT, I'm going to tell you exactly what I'm going to do. I'm going to come up here to studies. I'm going to cruise over to add study and cruise down to like volatility studies, and we're actually going to pull up implied volatility. Now we're going to look at implied volatility, which is the way that the options market denotes risk. The next thing I'm going to do is I'm going to come over here. I'm going to actually click directly on equities. I'm going to get rid of my volume subgraph because I just want to bring up purely some of the bond volatility. Bond volatility evidently is still rocking. Now this is a 9-month. Let's actually pop this up to like a 3-year. Okay, but I just want to like kind of justify bond volatility. Again, it's up there right now. Is it the highest we've seen? Absolutely, unequivocally, no. I mean, come on. The TLT volatility was clear up here, and the 50 handle. Again, but this is during the COVID crash. It's a little bit of an outlier. But I think you have to take this into consideration. Now, to put this in another way, okay, so bond volatility is high. What does that mean? Well, how high? Let's start to kind of justify that by looking specifically at the TLT. And again, we're going to look over here on the right-hand side of the screen. I want to kind of, give you a little bit of a feel. What I suggest you look at is somewhere about like 30-day volatility. Like 30-day volatility, it's very close to about the 20%, right? So it's about 20% is like 30-day volatility. What could we compare that to? Let's cruise over to the spiders. Like, what's S&P volatility right now, 30 days out? And here we are in the S&Ps. And the S&P volatility, about 30 days out, it's about 23%. So one of the first things that you have to recognize about this marketplace, we have an unusual circumstance where TLT, which is, of course, the ETF for bonds, and it's approximately the 20-year, but bond volatility is almost equivalent, okay, to S&P volatility. And I'll make the argument all day long. It's the bonds that are actually driving equity markets right now. And that's why I made the statement. Like, you can look at, MACDs and Fibonacci's and Bollinger Bands till you're blue in the face in the S&Ps. And you're going to decipher absolutely nothing. Looking at bond volatility is going to give you a little bit of insight. The bonds, okay, clearly there's something up. And we're going to go much deeper into that here momentarily. Okay? Now, before I go any deeper into that, and again, this is a little bit of a recap of markets, right? You're seeing like 20% implied volatility inside of the bonds. Again, how does that compare? When you have to start to compare bond volatility to the spiders, we got an issue, and that's pretty clear. Then you start to realize it's the bonds and it's the interest rates that really sparked, and specifically the interest rates. We'll bring this up a couple of times. The TNX, which is the 10-year. I mean, this thing is clear up to north of 1.5%. If you've never actually read the TNX before, the TNX is not a quote-unquote tradable instrument, but this is 1.5, basically 5% on the on a 10-year, and it is this wicked move to the upside inside of the 10-year interest rate, of course, that sparked a lot of this. In fact, on a year-to-date basis, you start looking at this. You're looking at a 70% move up in interest rates on a year-to-date basis. If you actually looked at this from some of the lows, well, here, that's over the last year. It's almost 70%. But from the absolute lows, like one of the recent lows, this is actually 0.5% clear up to 1.5%. I mean, on a percentage basis, that kind of move, it's ridiculous. I've been talking about it day in and day out when I'm doing these nightly videos. And I think it's critical to understand that, because it's this kind of, the movement of rates, but it's the bond volatility, I think, that scares me more than anything. But the reason I'm mentioning bond volatility, and then I'm actually mentioning, well, the Nasdaq gets downright squirrely. Okay, the Nasdaq got squirrely. But if you take a look at auto expected moves, the Nasdaq did in fact pull back inside of its expected move throughout the course of the week. But the Nasdaq getting squirrely is in effect, okay, it's a byproduct, if you will, of bond volatility. It's a byproduct of interest rates exploding higher. And that's one of the most critical aspects to take away from this marketplace. The market all of a sudden became two-sided, volatility really picked up, and all of it belongs to bond volatility. Moving on. one of the most important things that you also have to recognize here, credit markets. Now, I'm not going to sit here and preach to anybody about credit markets for 10 or 15 minutes. Credit markets, they got issues, severe issues. What the issues happen to be, there's issues in repo land again. Now, without going too deep into the repo marketplace, because the repo marketplace is a deep dark hole from which we will never escape if we try to actually explain the entire repo marketplace. For the most part, you have massive issues that are surfacing inside of the repo marketplace. Okay, and the next thing, and I think a way to delineate this without having to go into detail about the repo markets, swap vol is flying. Okay, and what swap vol basically is, and we're actually going to bring this up again. This is the SR VIX. Okay, you can actually pull this up on any trading application. It's the SR VIX, and what this happens to be is interest rate swap vol index. Okay, now this is a professional, it's an over-the-counter product. But it is a professional level product, and this is not a product that's tradable. This is just looking at like, we look at the VIX, right? We look at the VIX to kind of justify that the SPX and overall S&P volatility is rocking in the marketplace as options traders. Well, this is a way of actually looking at, interest rate, swap volatility, and it's extreme. How extreme? And again, to kind of justify this a little bit deeper, the last time that we got even near this, you have to look. Actually, this is back once again at the COVID crash. All right, so it's the onset of COVID. It's the huge crash in the marketplace, and we're up there, people. And this is, I think that this more than any other individual factor on the screen, okay, is why right now, don't dare sit there and like, we could hit all-time highs in the marketplace. I have no problem with that. Do not dare try to buy a dip over here. Don't get in front of this move. And I said that literally last weekend. I said, do not get in front of this move because this is dangerous. All right. You know that there's credit market issues kind of surfacing. Jerome Powell even mentioned, all right, don't fight the Fed, and discussed some of the forthcoming, issues ahead of us. But the fact that swap volatility is flying, okay, again, do I have definitive reasons for the movement in this product? Absolutely, unequivocally not. Neither does anybody else. And I think that's what intimidates me the most out of a product like this. So whether you want to sit here and discuss interest rate swap volatility, this is something you can look up and spend the whole weekend talking about, swap vol. But nevertheless, it's a big standout because that the bonds are driving order flow to the S&Ps. The bonds are driving order flow clearly to the Nasdaq. I mean, the Nasdaq got squirrely on the fact that we're actually being driven by interest rates. And that swap volatility is through the roof over here, and that there's absolutely issues in the repo markets right now. Okay, these things are starting to add up. Okay, a little bit of a side effect over here and a fun little deviation for a moment. Then we also have the Tesla effect. Okay, and I actually wanted to mention this a little bit, because the Tesla effect has been actually a fairly large one. When we talk about, the Nasdaq getting absolutely kind of squirrely, hands down, there's some mystics in here, but hands down, Tesla's had one of the most substantial impacts. Tesla is now effectively down over 30% from the recent high of 900. Stock actually cresting all the way down into the mid 550 range before bouncing back up, right to about 600. Now, say this in the easiest way. I think that you could absolutely bounce. You could have some wicked bounces in here, maybe back even up to 700. Nevertheless, it's over in the near term for Tesla. And it's over in Tesla, but the problem is simply this. Tesla, and I want to actually kind of delineate this for a moment. Tesla, once again, is still almost a $600 billion market cap. But the issue that we have is that Tesla volatility has now even expanded further. I was talking about this the other night on one of the evening videos. Tesla volatility is clear up in the 30-day range, close to 100%, almost 100% volatility. So if you look at other mega market cap products, okay, they have like 33% implied volatility. So effectively, Tesla has 3 times the volatility. So you take the $600 billion market cap, and it's actually moving the markets. Tesla's moving the markets more than Amazon. Tesla's moving the markets way more than Google. Tesla right now, okay, is capable of moving the markets more than Apple. So we are getting a little bit of a Tesla effect. one of the other issues with Tesla, and this is actually an interesting issue that's being compounded, okay, is there's an ETF like XLY. Well, first of all, there's a ton of ETFs that are heavily vested towards Tesla, okay? XLY happens to be effectively one of them. Let me actually close that up and show you. This is an ETF that has lost, okay, its ability to have any degree of diversification. Take a look at the ETF on a percentage basis, some of the moves that it happens to be making here after being up nearly 10%. There was a point today, it was a full-blown crash in here. It was down 6% before rallying back up. It's still down 1.6% year-to-date basis. The XLY is in trouble. The more Tesla that is sold, the more the XLY has to sell Tesla. The other thing that's kind of ironic is there's a huge fund, okay, driven by ARK. If you're unfamiliar with ARK, this is actually Cathie Wood. Cathie Wood has come out and recently bought more Tesla. A little bit of a desperation trade. ARK is also, okay, absolutely imploding here. The further they implode, the more Tesla they have to sell, okay? The QQQ. The further it goes down, okay, the more Tesla they have to sell. In every major ETF that owns Tesla, okay, we're getting a little bit of what we term the Tesla effect. That unto itself can actually absolutely start to spiral out of control and even cause the S&Ps some pain. The rally would have been much more significant this afternoon. Again, the S&P is up 75. That rally would have been much more significant had it not been for the fact that Tesla was down $23. In effect, the S&Ps would have been up well over 100, okay, had it not been for Tesla. So the Tesla effect is a very, very large one. I wanted to bring it to your attention, and I'm going to tell you exactly why. It's not about Tesla, and it's not about my feelings on Tesla, and Tesla's going to bounce over here, neither here nor there, okay? It's about some of the other major monsters of tech, one of which is like Google. And Google bothers me because it's still up 21% on a year-to-date basis, okay? Been completely steadfast. It's completely and totally unscathed. Amazon, still in a relatively tight range, has done nothing, okay, since July. Facebook, the exact same animal, has done nothing since August, okay? Apple, okay? Apple seeing some sell-side activity, has done literally nothing since August, okay? And we can bring up all of the monsters of tech. They're nowhere to be found right now inside, okay, of the upside of the marketplace. Which brings us to the next point. We're going to talk a little bit about the financials here. The financials continue, first of all, to shock me. Now, that's my own opinion. The financials here, I would anticipate, okay, in this next week of trade, that we're actually going to see reversing the rotation. And when I say reversing the rotation, okay, all we've done as of late, okay, is we've sold some tech over the last couple of weeks, right? The Microsofts, the Apples. I mean, Apple hasn't been able to get out of its own way roughly since the last week here in January. Facebook, a little sell-side activity, maybe a little bit more mild. Again, Amazon can't get out of its own way, again, since roughly early February, but this has been, about a month of sell-side activity in Amazon. I think we're going to see a little bit of a reversal, okay, of fortune. The reversal, we're going to bid into tech, and then we're going to start to go after, okay, areas like the financials. Look for the financials to start to see some sell-side activity. Financials, they're ready to feel the wrath of bonds. With that, okay, I actually anticipate that the first move inside of the bond market could be a bid back. So if we're looking for a bid back up in the bonds, that's going to take rates lower. You take rates lower, you're absolutely going to, cut the legs out from under the financials. That could be a little bit of a momentary trade. I'm not saying that that's going to be persistent, okay, but look for the reverse, okay, in the rotation over there. Energy is very likely, all right, energy, it's just been on fire. Just on fire. I mean, energy, every single week we talk about it cracking outside the edge of the expected move. But in this particular case, you realize like energy's up like 40% year-to-date basis. Okay, I'm shorting here. I don't mind saying I'm getting run over right now, but I'm shorting here. Look for the reverse rotation, right? Bonds rally. We're actually going to smoke the financials. With financials, energy is likely to go down with those banks. Okay, now, the big question, is volatility going to subside? Okay. One of the things that really bothers me inside of the marketplace, okay, number one, correlation coefficient to the downside is completely elusive. It has not been there, all right? You've seen some pretty vicious sell-side activity in this marketplace, all right? You can't doubt that. I mean, look, just look at the S&Ps today. I mean, these things, that doesn't look that vicious, but we did trade from 38.11, okay, all the way down to 37.28. So the S&P sell off and sold off substantially. I mean, again, that's almost a 100-point down move before exploding back up throughout the course of the week. In fact, when you look at this is a 30-day 1 hour. I mean, there's some fairly tumultuous volatility in there. Oh, okay. In no point did we actually see the marketplace, though, hit really high degrees of correlation, maybe for a brief and fleeting moment, okay, in the depths of some of the sell-side activity. Specifically in Thursday, you saw some brief correlation, but net, we're not correlated. What you really want to see, you want to see instead of 92 stocks to the upside, you want to see every single stock to the downside, and we're puking our guts out on the side of the street. Sorry to be so graphic about it, but that's what you need to see for degrees of capitulation, okay? The other aspect that's kind of bothersome, and people are like, oh, all right, well, volatility is going to subside. Maybe, but we didn't see correlation to the downside. The other thing I'd keep an eye on, the dollar is smoking to the upside. I think this is a fear trade. I think a lot of sovereignties and I think a lot of institutional money managers, they're actually coming to the dollar. Why? Okay, because in the end, our crap is better than their crap. And if you've never heard me say that before, it simply means this. Where are you going to go? Where do you want your money right now? You want to be in the euro? Good luck to you. Well, you want to be in the Chinese yuan? Good luck to you. Maybe the Russian ruble is for you. Good luck to you. Everybody comes into the dollar when the crap is about to hit the fan. And this to me actually ties back to some of the issues in the credit markets. I think they're actually dumping into the dollar right now because professionals do see the issues in the credit markets. So I'm telling you, bonds and rates need to stabilize. They need to stabilize. You got to see bonds rally back up. Everybody's got to okay, let's see if that, if that swap volatility comes down. Swap volatility's got to cool off. It's got to be back down here at 70 before we're actually gonna wave the all clear. Again, I'm not even looking at the VIX. Who cares? Oh, the VIX was down 13%. Okay, it's secondary. All right, the dollar continues to rip to the upside. All right. Bond volatility is high. Swap volatility is high. Correlation hasn't been there. This is the stuff you need to pay attention to. Last but definitely not least, the SPX, the mother of all products, still denotes that we're going to have a fairly wild week. About $100 expected move. And again, where do I get those expected moves from? Okay, from the option chain. Look out to the March 12th expiration, just shy of $100 move. So net. This previous week of trade, you were looking for a $124 move. You didn't get all $124. We did not, and I want to make this clear, we did not hit the upside of the expected move. We didn't hit the downside of the expected move. Okay? People, I'm going to tell you right now, it's pretty much a foregone conclusion that this next week we're going to hit the upper or lower edge of the expected move. Get ready to rumble. All right? That upper edge, and let's get really, really specific. Okay? The upper edge of the expected move sits pretty much on 39.42. 39.42. Okay? The lower edge of the expected move, okay? You're at about 37.43. That upper edge of the expected move is effectively, okay, a hop, skip, and a jump from the all-time high. So you're coming into a week of trade where I don't mind saying, right? Listen, maybe the bonds, cool off. Maybe the dollar cools off. Maybe we didn't need correlation. You're going for an all-time high, okay? Or we're going to crack lower. Do not try to handicap the moves on an intraday basis that the S&Ps are throwing us, okay? Right now, volatility is rocking, and we're in the hands of the bonds. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.